This meeting is being recorded.
Okay, good evening. Good evening, Israr.
Good evening, ma'am.
Good evening. Is my audio video clear? Can we start?
Yes, ma'am.
Okay. Now, before going ahead, if there is any specific doubt specifically related to consolidation regarding the basics of PL and OCI and balance sheet, if there is any specific problem, you can go ahead and ask first. Otherwise, then after that, we'll try a full-fledged question in Excel sheet and I'll try to explain the basics related to each and every pointer, how you need to deal with each and every pointer. Okay?
Okay.
If you have any doubt, please ask.
अभी तो मैं स्टार्ट किया है मैडम, आज ही थोड़ा टॉपिक देख रहा था।
ओके
तो आज
ओके
ही जी।
ठीक है। आपको मेरी लैंग्वेज क्लियर है? कोई दिक्कत थोड़ी आ रही है लैंग्वेज में?
बिल्कुल क्लियर है, बिल्कुल सही है।
ओके ओके ठीक है
अच्छा,
ठीक है ओके। मैं इंग्लिश हिंदी दोनों में ही कंफर्टेबल हूँ। आपको अगर कहीं पर भी कंफ्यूजन लगे तो आप मुझे एक बार हैंड रेस कर देना या फिर चैट बॉक्स में लिख देना या फिर अनम्यूट करके आप पूछ सकते हैं। ठीक है
ओके ओके
ओके। एवरीबॉडी ऑल सेट? Can we
यस
start a full-fledged question? Valentina, Kishan, please give me a quick thumbs up. Kishan, give me a quick thumbs up. All set? Is there any audio video issue? Yes. Okay. Yes, Israr, please ask.
नो you may continue.
Okay, okay. Hand raise is to ask question and thumbs up is to say that okay, everything fine, we can go ahead. Okay.
Okay.
Let's try one full-fledged question. Parent is a public listed company. Okay, it's a public listed company which has acquired 600 million equity shares in offspring company. Okay, so firstly we have to check whether control exists or not. On the basis of this, we will decide whether there is parent and subsidiary relationship, yes or no. Okay, so they have acquired 600 million equity shares. We have to check how many shares are there in offspring company. Okay, parentage company is your acquirer, is your purchaser, is your investor, whereas offspring company is your acquiree, the company which is being purchased. Let's look at the equity shares of offspring company. Okay. So the share capital is given. The share capital of offspring company is given equity shares of 0.25 each dollar. So you can say 0.25 dollar or you can say 25 cents. Give me a quick thumbs up. Either you can say $0.25 or you can say 25 cents. Okay, and the figures are given in $1 million. Figures are already given in $1 million. Good, very good. Okay, $1 million. This means the question says that the subsidiary total share capital of subsidiary is $200 million. Okay, total share capital. Can you tell me the number of shares? Can you calculate total number of shares? This is share capital. That means number of shares multiplied by face value per share. Can you calculate number of shares, or you can say equity shares? Equity shares of subsidiary. Okay, subsidiary or offspring company. How many number of shares? Kishan says 800 million. Okay. What about others? I want to answer from each and every one. Okay. We actively try to answer It's fine even if it's incorrect. Okay, try your answer. Isra says 50 million.
Ma'am,
Yes.
even I got 800, 200 divided by 0.25.
Correct. Okay, so number of equity shares are, okay, total share capital equals to total share capital divided by face value per share. Per share. So your total share capital is $200 million divided by face value per share is $0.25. $0.25. So your total equity shares equal to 800 million equity shares. Okay. Now the question says that they have acquired 600 million equity shares. They have acquired 600 million equity shares. So can you tell me the percentage of holding? Everybody, good, 75%. Okay. So since there is 75%, therefore we will say control exists. Okay. So control exists. There is parent and subsidiary relationship. Okay. Parent has 75% holding, whereas NCI equals to 25%. Please give me a quick thumbs up. Is there any doubt? Please ask. Good, good. Good. Israr, is it clear? 600 million equity shares divided by 800 million equity shares equals to 75%. Good, very good. Okay. So we are clear with this. So this is our parent company, this is our subsidiary company, and percentage of holding is 75%, NCI is 25%. Okay. Now the question says that there is a purchase consideration. This means parent company while acquiring, while purchasing has paid a consideration. Okay. And the consideration is not paid only in cash directly. Instead, there are 2-3 components of PC. Okay. Let's look at them and try to calculate each of them. If you could relate with this question, there is one example in your statement of financial position when we studied. There is one example where we calculated PC and there were 4 types of PC. Do you remember? Everybody, do you remember that question? Yes or no? Good, good. Wherein we said that if it's a share exchange, we will record at fair value. Okay. If it is the issue of 100% loan notes acquired, this will also be recorded at fair value. Deferred consideration will be recorded at present value. If it's a direct cash payment, we will record it at same price. Okay, issue of $100, 10% loan notes for every 500 shares acquired. This will also be recorded at fair value, issue value. Okay, now 3 pointers are there. We'll try to calculate this. A share exchange of 1 share in parent is for 2 shares in offspring company. Okay, 1 share has been issued for every 2 shares acquired. How many shares have been acquired? 600 million shares have been acquired. For each 2 shares, they have issued 1 equity shares. So how many shares issued? 300 million equity shares. Valentina, do you agree? Isra, do you agree? That parent is for every 2 shares, they have issued 1 share. Total, good, very good, super. So 600 million, out of this, for every 2 shares, they have issued 1 share. So what we can do, okay, we can Instead of solving in rough, we can directly solve in our Excel sheet. Okay, I'll tell you how to approach and solve it in your Excel sheet or spreadsheet. So firstly, make a rule and learn a format of your statement of financial position as well as PL and OCI. Okay, in this question, they are asking us to prepare consolidated statement of financial position. Approximately, it takes 30 to 35 lines to prepare entire pro forma and format for consolidated statement of financial position. So what we'll do, we'll leave 30 to 35 lines approximately, and from here onwards, we'll start our working notes. Okay. We will start our working notes. After 35 lines, I've left lines for pro forma. Okay, we'll start our working note. Working note number 1 is always for group structure. So, working note number 1 is for group structure. Okay, what is our group structure? We have parent, parent is company, and we have offspring company. We'll solve this question very slowly so that you are very clear with your basics, and then you'll be able to solve 100 plus questions when you practice. Okay, we'll solve this with little patience. We'll go step by step. Okay, so what is the percentage of holding? Parent has this is our parent company and this is our subsidiary company. Okay, percentage of holding, percentage of holding is 75%. How have you calculated? 600 million shares into 100 divided by 800 million shares. Okay, we have calculated in this manner. Okay, next. What is your date of acquisition? What is your date of acquisition?
For
Good. 1st January 2003 is your date of acquisition, the date when parent acquired control. And what is your date of reporting? 31st December 2003. So date of acquisition is 1st January 2003, whereas date of reporting is 31st December 2003. Okay. Now, can you tell me the pre and post period?
ma'am, how can they be like pre-period? Because the start of the year is 1st January.
Correct, correct. Now, what happens? The offspring company has been good, very good. Okay. Offspring company has been acquired on 1st January, but it might be running its business from last 5 years or 50 years, maybe. So, those last 5 years and 50 years will be considered as pre-period. Anything earned before acquisition will be considered as pre-acquisition profits. Do you agree?
Yes, ma'am.
Okay. So, therefore, there is pre and post period. There is pre and post period. This is your 1st Jan 2003 and this is your 31st December 2003. This is your acquisition date, whereas this is your reporting date. Okay. Now, anything earned before this period will be considered as pre-period, pre-acquisition period. Anything earned during this period will be considered as post-acquisition period. Okay. This will be considered for goodwill calculation. And this will be considered and added to CFS, okay, as 2 sections, to parent and NCI. Clear? At the rate their percentage of holding, that is 75% and 25%. So, can you identify what is your pre-profits? Anybody, any doubt in this? Please raise hand. Anybody, any doubt in this pre and post? Okay, now on this basis, can you tell me what is my pre-acquisition reserves? Can you tell me what is our pre-acquisition reserves? Kishan says 210. What about Israr and Valentina?
Ma'am, I have no idea.
Okay. Kishan, why 210? This is your parent company. You never bifurcate pre and post amounts regarding your parent. We always bifurcate only for subsidiary. See, subsidiary has been acquired. Offspring company has been acquired. Now the total retained earnings of the offspring company will be divided into 2 sections, pre and post. So total earnings are 140. Total earnings of subsidiary company are 140. Anything till the time of acquisition, till the date of acquisition, will be considered as pre. Anything earned during the year after acquisition date will be considered as post. So in this case, 120 is your pre-profits because they are related to pre-acquisition period. Anything earned after acquisition date will be considered as post-acquisition period profits. Is it clear? 120 and 200, is it clear?
Ma'am, 120 will be our pre-acquisition profit and the
Correct.
opening as well.
And opening as well. Yes, in this situation, yes. Maybe for example, just an example, if the acquisition has been done on maybe 1st March, then your pre-profits would have been 120 plus 20 into January and February are pre-periods, whereas 1st March to 31st December is your post period. Do you agree? Yes or no?
Yes, ma'am.
Okay, then in this case, pre-period would have been 2 by 12. So 20 into 2 by 12. 20 into 2 by 12. 3.33. So your 123.33 would have been your pre-profits. Got it? In our
Yes, ma'am.
current in our current question, our opening date and acquisition dates are exactly same. Therefore, we have not proportionated this 20 into pre and post, because this entire year is your post period, because the acquisition has taken place on the start of the year itself. Give me a quick thumbs up. I want quick thumbs up from each and everyone to go ahead. Are you clear what happens in case if it's a 1st January acquisition date and what happens in case if it's a 1st March acquisition date? Are you able to bifurcate between pre and post? Israr, is there any language issue? Is it all right? Okay, good. Okay, please stop me then and there in case if you are stuck. Okay. Now, as part of our preparation, as part of our question, we will say what is our pre-acquisition profits or retained earnings. Pre-acquisition retained earnings equals to $120 million. Okay, this is our working note number 1. We'll go ahead with working note number 2. Working note number 2 is always goodwill calculation. Okay, what is our goodwill calculation? We have a format for goodwill calculation, which is purchase consideration plus non-controlling interest on acquisition date. This is our format we have learnt in class. We add this up, then we'll deduct less fair value of net asset acquired. Fair value of net asset acquired. Okay. In this, how do you calculate your net asset of subsidiary? We'll deduct net asset of subsidiary. Okay. Of subsidiary or of spring company. Of okay. Is there anybody who does not know this particular formula format? Share capital. Please raise hand if you do not know this format. Please raise hand. Okay. Okay. Other than Valentina, do you know this? Any doubt?
Yes, ma'am, I know this.
Good. Okay. Okay. Isra, when you'll read ahead, it is part of our basic discussion itself. But still, I'll try to tell you. Okay. I'll try to discuss the same. Share capital pre-acquisition, in case if there is any fair value adjustment, okay, on acquisition date. Okay, any fair value adjustment on acquisition date or before acquisition will be considered for goodwill calculation. And anything, any movement that takes place after acquisition date will be adjusted in our CFS, in our post acquisition retained earnings. Give me a quick thumbs up. Do you understand? Fair value adjustment, okay, on the date of acquisition, any adjustment, pre-acquisition fair value adjustment will be taken for goodwill calculation. Any post-acquisition adjustment, movement in fair value will be added to CFS. Give me a quick thumbs up. Clear? Good. Any doubt? Good. Okay, so what we'll do, we'll read the question ahead and check. Then we'll calculate goodwill. For goodwill calculation, firstly we need to calculate purchase consideration. We do not have purchase consideration right away. So we'll make a working note. Working note number 3 is to calculate purchase consideration. Okay, now there is shares issued. Okay, and what else? There are shares issued, and then there is loan note issued, loan notes issued, and then there are deferred cash payment, deferred consideration. Okay, shares issued we'll calculate at fair value. We'll record at fair value on the date of acquisition of the acquirer, of the investor, of the purchaser. Okay, loan notes will take at the issue price, or you can say fair value itself. We'll take at issue price or fair value. Deferred consideration will take at present value. Okay, we'll calculate the same. Fair value of shares issued. How many shares issued? For 600, every 2 shares, 300 shares issued, and the loan notes have already been recorded. Parent is companies at the date of acquisition is 0.75. Okay, one important pointer. Out of this $0.75, we have face value and securities premium. Face value is $0.25 and securities premium is $0.50. If parent company is issuing shares, it will increase share capital in consolidated statement. If parent company is issuing loan notes, it will increase liability in the consolidated financial statement. We never take any share capital and pre-acquisition reserves of subsidiary when we are going ahead with full consolidation. But when we talk about our parent, if parent has issued any shares, it will increase share capital in consolidated financial statement. Everybody clear? Good. Give me a raise hand in case if there is any doubt. Okay, so if we talk about share capital, so 600, good, very good. 600 million shares. And the ratio is for every 2 shares, 1 share issued. So 1/2. And the issue price is $0.75. Okay, so what should be the amount? 600 divided by 2 into 0.75. So your value is $225. Okay, what is the price of loan note? What is the amount of loan notes? Now, loan notes have been issued, okay, $100 each for every 500 shares. So how many shares have been acquired? 600 million shares have been acquired. Okay, 600 million shares have been acquired. 600 million shares have been acquired, and they say that they will issue 1 share for every 500 shares acquired, and the issue price is $100 each. So 600 into 100 divided by 500, 120. Present value. Everybody clear? Anybody any doubt in 120 and 225? Why, how, any calculation or any other issue?
Ma'am, can you please explain loan notes once again?
Okay, sure. Now the parent says that Read this line, the issue of $100. So the worth of each loan note is $100. You can say that the principal value, the face value, okay, the basic value of each loan note is $100. It's a 10% loan note. It attracts 10% interest rate for every 500 shares acquired. So if you have acquired, for example, if you have acquired 1,000 shares of offspring company, you would have issued only 2 loan notes. Got it? For every 500 shares acquired, they have issued 1 loan note. How many shares acquired? 600 million. Out of the 600 million, for every 500 shares, they are issuing 1 loan note. Got it? So 600.
Yes, ma'am.
What is the issue ratio? 1 divided by 500. Okay, 1 loan note for every 500 shares acquired. And what is the issue price? It is $100. Okay, Israr and Kishan, is it clear? Valentina, clear?
Yes,
Good,
ma'am.
good. Okay, super. Now, we'll talk about deferred consideration. If we talk about deferred consideration, we are not paying it today itself. Instead, we have said that a cash payment of $0.11 per share acquired. So, how many shares acquired? 600 million shares acquired. For each share, they are wishing to pay $0.11 payable on 1st January 2004. That means at the rate 1 year later. At the rate 1 year later. Clear? So we'll calculate present value. Is there any rate given? The cost of capital is given 10%. So we will use this 10% to calculate present value factor. Clear? So deferred consideration will be recorded at acquisition date. Record at acquisition date. What is the amount? 600 million shares into $0.11 each. Please calculate. $66 million. Now this is your entire value. We will multiply with, good, very good. We will multiply with present value factor. How do you calculate present value factor? PVF equals to 1 divided by 1 plus rate raised to the power number of years. So 1 divided by 1 plus rate. What is your rate? 0.10. 10% is your rate. Raised to the power how many years? The delay, the deferment is for 1 year. 1. Okay. So our PV factor, okay, multiplied by PV factor, that is 1 divided by 1.1. So 66 multiplied by, please calculate 66 multiplied by, good, 66 multiplied by 1 equals to $60 million. Do you agree? What will be the journal entry? At year 0 on acquisition date, okay, or you can say year 1 itself. Okay, net asset debit to deferred consideration liability or provision, one and the same thing, liability or provision. Okay, it will be of $60 million and $60 million. Correct? Anybody, any doubt? Now, at year 1, end of year 1, do you agree that this is your liability? Uh, this is your liability. Everybody, do you agree? This is a liability that needs to be paid 1 year later. Good,
Yes, ma'am.
good. And therefore, this will attract interest rate. So during the year, this is during the year. During the year, okay, you will record finance cost, or you can say interest cost. Finance cost, finance charge, debit to deferred consideration, liability or provision, one and the same thing. Okay, please calculate at the rate 10%. So 60 million into 10%, 6 million. This will be charged to PL. This will be shown in PL as an expense. Your expense in PL will increase. Your profits in PL will decrease. Everybody clear? Anybody any doubt? Anybody any doubt? How have we calculated? At the rate 10%. This is the interest that you're charging on the liability during the year. Good, very good, super. Now this is your post acquisition movement. Okay, this is your post period adjustment, post acquisition period adjustment. Whereas this is your on the date of acquisition. And when it will be paid actually in the final year, the on actual payment, okay, on actual payment on 1st Jan 2004. Can you tell me what will be your journal entry? Sorry. Can you guess what will be your journal entry?
Deferred consideration account debit to cash. I'm not sure. It's a guess.
Correct. Okay, please tell me what amount?
66 million. Or
Correct, perfect. To cash or bank, that is 66 million. Okay, so 66 million is payable at the year end, but today itself we will not record 66 entirely. Instead, we'll record only the present value. During the year, we are charging interest amount on the same using the rate by which we have calculated PE. This is also known as unwinding of discount. By unwinding of discount, your expense in PL increases, your profits in PL decreases, your deferred consideration provision and liability increases and tries to match the final amount that is actually paid. Everybody clear? Anybody any doubt? Any doubt? So we'll head towards
no,
our
ma'am.
PC. Good. We'll head towards our PC. Very good. Okay, so present value, how have you calculated? Present value 600 million shares. Okay, multiplied by present value factor. That is, sorry, 0 point, amount is $0.11. Multiplied by present value factor. Present value factor is 1 divided by 1.1. Okay, this is how you've got 60 million as your amount. So your purchase consideration total amount is 405 is your purchase consideration. How have you calculated? Using Working note number 3. So purchase consideration equals to $405 million. How have you calculated? Using working note number 3. Okay, NCI on acquisition date. Let's read our question. Okay, the value is given: property, plant and equipment, investment, intellectual property, inventories, trade receivable, cash. Then equity shares, retained earning, 10% loan notes already recorded. Okay, trade payables, current tax payable, overdraft, equities and liabilities. Is it clearly visible? Everybody please confirm. Good, good. Okay, okay. Now I'm quickly heading towards our NCI. Later we'll read entire other information. Now it is parent company's choice which method to elect. There are two methods already you know. So NCI can be calculated using proportionate method or fair value method. Now the company has elected to use fair value method for calculation of non-controlling interest. And the fair value of non-controlling interest on the date of acquisition has been given $97 million. Okay, so in our Excel sheet, can we use 97 as our amount? $97 million. Let's calculate this and get a total. 502. Now we'll deduct share capital of offspring company. Now despite we might have 50%, 60%, 70, 80, 90, 100. Okay, irrespective of percentage holding, we'll deduct 100% of subsidiaries share capital. What is subsidiary share capital? Subsidiary share capital is 200 million. Subsidiary share capital is 200 million and pre-acquisition reserves are 120. So $200 million and 120. Is there any fair value adjustment? Let's look at it. Now, the question says that at the date of acquisition, the fair values of offspring companies, that is subsidiaries net asset, were approximately equal to their carrying amounts with the exception of its properties. So only property amounts are different. Other than this, everything in the net asset in the books of account of subsidiary are as it is equivalent to their fair values at the value at which the parent is trying to acquire and record it in their books of account. These property values, fair value has been given $40 million in excess of their carrying amount, which would create additional depreciation of $2 million. Okay, so we'll make a fair value note. Working note number 4, which is fair value adjustment. Okay, fair value adjustment. Your opening amount, movement during post-acquisition period, and this is your closing amount. Okay, so we have properties. Question says that on the date of acquisition, it is increased by $40 million. And it says that the depreciation during the year will be $2. So the closing amount will be 38. Now, please understand. This will be taken to Goodwill calculation because this is done on or before acquisition date. This is your post-acquisition movement. This will be added to CFS and this will be shown in CFS. Okay. Show, add to CFS. Okay, this will also be added to CFS, but this will be adjusted in post acquisition profits of subsidiary. Give me a quick thumbs up. Anybody, any doubt? Please confirm. Anybody, any doubt? Are you getting it? Fair value adjustment on or before the date of acquisition will be taken for goodwill calculation. Anything during post period will be adjusted in post acquisition profits of subsidiary and the closing amount will be reflected in your CFS. Everybody give me a quick thumbs up. Valentina, Israr. Good, good. Any doubt with fair value? See, there are so many questions which are similar adjustments. They have PC in this manner, they have fair value adjustment. If you are clear with the basic rule, then it won't trouble you anymore. Okay. So what we'll do? Fair value up valuation. This is profit. This will increase their net asset. Okay. This is a up valuation, 40 million. This will increase their net asset. So this will be added. Similarly, for example, there is any other liability, contingent, provision, anything, any other liability, we would have decreased that. For example, if it would have been downward valuation, we would have decreased from here. Give me a quick thumbs up. Since it's a fair value upward valuation, it is increasing the net asset, therefore we are adding over here. Otherwise, we would have decreased it. If it would have been a downward valuation. If there is any provision on the date of acquisition, any contingent provision, any liability, it would be decreased. If there is any unrecorded intangible asset like brand, patent, etc., it would be added. Okay, so this is your fair value total. Now we have to add this up. Equals to minus sum total minus equal to this. There are a lot of calculations. Can we attempt? Can we attempt all questions in time? Definitely yes. I guarantee this. There is ample of time available, but we need to practice. We need to know actually what will be done. You should know that you have to leave these many lines. You need to learn the formats. Once you solve at least 5 to 6 questions, you'll get to know what are the repetitive adjustments that take place. What are the repetitive working notes. That's how you will be able to complete it within half an hour time. Okay, sir? No worries. So what is your goodwill? Goodwill on acquisition date equals to 142. Here? Any doubt till here? Anybody, any doubt till here? Good, good. Okay, super. What we'll do, we'll try to prepare the format quickly. Okay, we'll try to follow the format already given in the question. So question says asset side, asset as non-current asset, investments, intellectual property, current asset. Okay, we'll try to solve this in this manner itself. Okay, so we have property, plant and equipment, and then investment, intellectual property. So we have asset side. Okay, then we have non-current asset. Okay, we have property, plant and equipment, rightful. Property, plant and equipment. Okay, then we have investments. Then we have intellectual property. Also, we'll have goodwill. Okay, then after that, we have current asset. There is no mandatory to leave a line, it is all up to you. In current asset, we have inventories, trade receivable, and cash. Inventories, trade receivable, and cash. Okay, that's how we will have total assets. Okay, then we'll head towards equity and liabilities. Liabilities, we'll start with equity. Equity will have equity share capital. Then it will have securities premium. Okay, then it will have retained earnings. Also, it can have reval surplus. Right now, it is not having. Okay, any other income, any other pointer. Then we have non-controlling interest. Okay, after non-controlling interest, we'll have 10% loan notes. Okay, non-current liability. 10% loan notes. Then we have current liabilities. Okay, current liabilities. And in current liabilities, we have trade payable, current tax payable, OD. Trade payable, current tax payable, and overdraft. Okay, that's how we'll have total equity and liabilities. Okay, what we'll do, whatever amount we have till now calculated, we'll try to put its impact. So firstly, PC, purchase consideration 405, NCI. Okay, share capital. So in your share capital, fair value adjustment. Okay, shares issued. How many shares issued? 300 million shares issued. Okay, so what we'll do, any shares that have been issued by parent company, okay, we have to add 300 million shares into $0.25. We need to add. Whatever amount we'll take, we'll add this. Securities premium, again, we'll add whatever amount there is, 300 million shares, okay, into $0.50. Give me a quick thumbs up. Do you agree? Anybody, any doubt till here? For every 2 shares acquired, we have issued 1 equity share. So that means 300 equity shares issued for 600 million shares acquired, and they have been issued at 0.75. So face value is 0.25 and securities premium is 0.50. If parent issues share capital, it increases share capital in CFS. Valentina, Israr, give me a quick thumbs up. Is it clear?
Ma'am, I didn't understand for the parent one.
Okay, what? Please ask. What did you not understand? What is the confusion?
Ma'am, you said now for parent we don't need to add.
For parent, we don't need to add. Wait, see, when we are adding, when we are preparing consolidated balance sheet, okay, we add all assets and all liabilities line by line. Do you agree? Yes or no?
Yes, ma'am.
Okay. And when we talk about share capital, we only add shares of parent. We never add share capital of subsidiary. Do you agree? Yes or no?
Yes, ma'am.
Okay. So when we are adding only of parent share capital, okay, so subsidiary share capital will not be added. While we are preparing CFS, subsidiaries share capital will not be added. We are clear till here? Okay. Now, on the date of acquisition, if parent has issued any shares, then this will increase share capital of parent. Got it?
If parent have issued share, then only it will be
Then it will increase share
increased.
capital of parent.
And in case of
And in
subsidiary, ma'am.
see, if subsidiary has see, we never include share capital of subsidiary. So whether they increase share capital, issue share capital, or buy back any share capital, it will not impact. It will not impact CFS.
Okay, ma'am.
Got
Understood.
it? Got it? Because we ignore. We do never include share capital of subsidiary. Okay, so it is unaffected. Okay, got it? Next, the question has said that about loan notes. Loan notes have already been taken care. They have already issued loan notes and deferred consideration. Okay, we'll record deferred consideration liability. We'll record over here. Deferred. Okay, that is of 60 million. Okay, right now it is of 60 million. Now, since in your exam, in your spreadsheet, there is no insert row or insert column option. So what you'll do, you will control X this and you will paste it downwards. Okay, control X and control V can be used to shift in case if insert row and insert column is not available. Okay. Next, if we talk about fair value adjustment, okay, fair value adjustment for goodwill we have already taken care. Okay, now working note number 5, that is consolidated retained earnings. Okay, we have parent and we have offspring. As per question, okay, later we'll deduct excess depreciation on fair value of property. That is, from offspring we'll deduct -2. Any doubt? And the closing amount will be written in the balance sheet. That is, property, plant and equipment will add plus 38. Are we clear with fair value adjustment? 40 we have taken for goodwill calculation, 2 we have deducted from retained earnings, post acquisition profits of subsidiary, and 38 we have shown in CFS. Any doubt? Give me a quick thumbs up. Is it clear? Okay, next. Now, as per question, our profits are 300 and 140. As per question, our profits are 300 and 140. Okay, we'll deduct less the acquisition. In our question, it is minus 1. Okay, so we'll deduct this is our post-acquisition profits. If there is any other adjustment during post-acquisition, we'll adjust it and then we'll get post-acquisition profits of subsidiary and then we'll bifurcate and add it into our parent and NCI. Okay, our working note number 6 will be non-current. NCI. Okay. So we have taken first. Now second, the intellectual property in a system is a system of encryption designed to for internet use. Offspring has been advised that government legislation passed since acquisition has now made this type of encryption illegal. Offspring company will receive 10 million in compensation for the government. Okay, please read this line again, second pointer. I'll tell you the solution. Please read the second pointer again. There is an intellectual property which was very valuable. Now it has become illegal. We need to de-recognize from our books of account during post-acquisition period. Everybody clear? Please read second pointer again. It has become illegal. Now you had already a value of intellectual property is of 30 million. We need to de-recognize this. De-recognize. How do you de-recognize? Is it illegal means need write off? Yes, definitely. You cannot continue to recognize as your asset. De-recognize from books. How do you de-recognize from books? By passing a reversal journal entry. Okay, so good, very good. Working note number 7 is your intellectual property. Okay, what journal entry will you pass? Firstly, to intellectual. Okay, that is 30 million. PL. Okay, and it will be PL. Okay, the same amount will be charged to PL. But the question says that out of 30 million, they are expecting that they will receive 10 million from government. So that means receivable, compensation receivable from government is $10 million. This means the remaining amount will be charged to PL. Now it is related to our subsidies post profit. So it will be adjusted in the retained earnings of subsidiary. Okay. So it will be adjusted in the, sorry, it is parents, I would say loss. So retained earnings debit by balance in figure, that is 20 million. Now, in case if the question would have said that we need to require PL and OCI statement, then we would have charged this 20 million to PL. Right now, we are not recording our PL, we are not preparing our PL, we are directly preparing balance sheet. So, every PL impact is directly taken towards retained earning. Anybody, any doubt regarding our working note number 7? Please confirm, anybody, any doubt? Good. Okay, so very good. So, firstly, our intellectual property will be 0. Okay, derecognized because it became illegal. Okay, and if somebody wants, they can refer working note number 7. So, we will record intellectual property as 0. Okay, next, there are 2 more items. Receivable from government. So, we'll increase our balance sheet. Receivable from government. Okay, receivable from government. How much? $10 million. Okay, and then there is a loss of $20 million. There is a loss of $20 million. This will be deducted from our retained earnings. So loss on derecognition of intellectual property. The loss is minus 20. Derecognition of intellectual property. Anybody, any doubt? Whenever there is any additional information which has not been included yet in the books of account, then make sure you are putting its double effect simultaneously in order to make sure that your balance sheet debit and credit matches. Everybody, whenever there is a, I would say, any additional information and you are putting its impact, make sure you are putting its impact in the double impact. For example, depreciation. So you have charged to your retained earnings as well as you have deducted from your closing amount. Okay, anything. Make sure that you record it on both the sides. Okay, next. So second pointer also clear. First and second taken care. Second, third. Offspring sold parent is goods for $15 million in the post-acquisition period. That means parent and subsidiary relationship exist in post-acquisition period. Out of this, $5 million of these are included in inventories. This means 5 million is unsold. 1/3 is still unsold. They have sold 15 million and still unsold. This IP for related to parent, so entire amount went to retain. Why IP is related to parent? Intellectual property is of subsidiary or parent? This intellectual property, why parent? See, it is there in the books of subsidiary. Valentina, please confirm. Intellectual property is in the books of subsidiary or parent? It lies in the books of subsidiary. Yes.
Ma'am, then NCI should also be getting the share of it, no?
Correct, correct. Perfect. So, when you will give the share?
My question is...
Okay, later.
Sorry?
Yes, how you will provide the share? When you will calculate this all and then you will have a post amount. This will be bifurcated to parent and NCI. Valentina, you are correct. Got it? That this is being deducted from the post-acquisition profits of subsidiary. Any amount, any adjustment that affects subsidiary's post-profit will be affecting NCI also. Correct. Okay? Okay, good. Now they have been sold. Okay, 1/3 is lying unsold. The profit made by Offspring on these sales was $6 million. So profit is 6 million. Offspring trade payable account. Okay, there are two transactions. Let me try. Who is the seller? Parent company or subsidiary company? Who is the seller? Offspring company. Good, very good. And parent is company. Offspring is your seller, is your subsidiary, whereas parent company is your buyer, that is parent company. Offspring company has sold goods and the goods are worth $15 million. Okay, sold goods. Now the parent company has sold to third party. Okay, 10 million worth goods have been sold, 2/3 sold. Please understand, unsold stocks are lying. Therefore, unsold stock equals to 1/3. Here, parent company, which is your buyer, has sold it to third party, outsiders. Please understand, this is your actual profits. And these are your unrealized profits. And these are your unrealized profits. Is my audio video clear? Good. No, not clear. Please give me a quick thumbs up. Is my audio video clear? Okay. Is my screen properly visible? Voice breaking. Okay, okay. Give me a minute. I'll cross check once. Hello, please confirm. Is it better? Is it fine? Okay, thank you. Okay, now good. So the total profits are $6 million. Out of this, 1/3 is unrealized and 2/3 is actual profit for group. So we will remove only unrealized profit. That is 6 million into 1/3. Clear? So we'll remove unrealized profit of only 1/3. That is 6 million into 1/3. Who is the seller? So unrealized profits. Okay, eliminate from sellers retained earnings. Okay, who is seller? Offspring company is seller. Seller has unrealized profit of 6 million into 1/3. That is 2 million. Any doubt? And simultaneously, the unrealized profit will be decreased from buyer's inventory. Where is buyer? Inventory. So inventory of buyer will be deducted. Deduct unrealized profit of 2 million. Give me a quick thumbs up. Everybody clear? Anybody any doubt? Seller's retained earning consists of unrealized profit and buyer's unsold inventory has unrealized profit. So we have removed from both the ends. Anybody any doubt? Good, good. Okay, last. The question says that Offspring, who is your seller, has a trade payable account in parent's company of 7 million. Okay, this means buyer has trade payable. So trade payable balance is of $7 million. Still required to be paid. Whereas, which does not agree with parent's company's trade receivable account in offspring company due to cash in transit of 4 million paid by parent's company. So 7 plus. So offspring company has a trade receivable, okay, of $11. Now we need to cancel intra-group balances. One says it's a payable for me, another says it's a receivable for me. And as a group, it is neither an inflow nor an outflow from the group perspective. It is just a flow from one pocket to another. Okay, it does not increase or decrease the wealth of the group. Therefore, we have to cancel intra-group balances. But we can see that there is a cash in transit. We can observe that there is a mismatch and there is a cash in transit of $4 million. Okay, cash in transit of $4 million. We need to assume and push transaction in the books of final receiver. Who is final receiver of cash? Who is final receiver of cash? Is it seller company or buyer company? Who should receive cash? Seller company should receive cash. Who is your final receiver? Seller company is your final receiver. Final receiver of cash. And therefore, we'll pass two journal entries. First journal entry will be cash. Okay, let me write it in the Excel sheet itself. Okay, intra-group balances. Working note number 8. Intra-group balances. Okay, so our first entry will be cash in transit, debit by $4 million. And it has been received by seller company. This means trade receivable balance will go down. So to trade receivable, that is $4 million. Then our second journal entry will be trade payable debit $7 million. to trade receivable. Trade receivable of 7 million. Give me a quick thumbs up. Any doubt? Please confirm. Any doubt? Good, good. Okay, so cash in transit will increase cash. So cash in transit. Cash in transit of 4 million will be added. Okay. And trade receivable will be deducted. 4 million. It will be deducted 4 million. Okay. So your balance sheet is matched. Cash in transit increased. Trade receivable debit. Trade receivable deducted. Then we will deduct trade receivable balance and 7 million balance. And we'll deduct trade payable balance by 7 million. Okay, intra-group balance. Last, as you know, there is unrealized profit, there is deferred consideration. So we have to record interest also. So interest on deferred consideration is 60 plus 6. That is 66. And it will decrease the profits and increase the expenses. So our unwinding of discount equals to 6. And this is a loss, this is an expense. So minus 6. Now, NCI on acquisition date equals to 97 given in the question itself. Okay, we'll add share of profit. So minus 4 is your post acquisition profit. Post acquisition profits of offspring company. Okay, is 4. So profit, or you can say post acquisition, this is your loss. Now this will be added to CFS in parent and NCI share. So parent will get group share of post acquisition loss, okay, of offspring company. That is minus 4 into 75%. That is minus 3. And similarly, group share of post acquisition loss of offspring company will be given to NCI also. That is minus 4 into 25%. Minus 1. This is NCI on reporting date. Okay, so retained earnings equal to 291. Retained earnings equals to working note number 5. Retained earning equals to 291. Working note number 5. Okay, intellectual property adjustment. Which adjustment here? Already taken care. Look at this. See, please understand this -4. Valentina, this -4 is after taking care all the adjustment that has taken place during post acquisition period. So it already includes loss due to derecognition of intellectual property, movement during the year, depreciation, etc. Got it? In case if you attribute -20 into 25% again to NCI, then it would be double deduction. Got it? Valentina, please confirm, is it clear? This -4, very good. This -4 is after considering all the adjustments that have taken place during post-acquisition period.
Ma'am, we'll get marks if we do directly instead of showing it in the working. Like, I mean to say, we have to show it in the working as well.
We
And
have
take the
to show
final
it.
amount over here.
Correct, correct. We have to show it in this manner itself. Got it? We
I
have
mean
to
to
show
say,
this. Yes.
I mean to say that NCI ka share we have to take and the total which is coming, and then we can take that in the balance sheet.
This 96. Are you talking about 96 or something else? Which figure?
Ma'am, and this 96 intellectual property is not been this. They have not taken the share of that. In the balance sheet, you deducted it from the balance sheet, right?
See, what will be the journal entry on derecognition of intellectual property? See, out of this 20 million, retained parent will get 15 million deduction and NCI will get 5 million deduction. Do you agree? Yes or no?
Yes, ma'am.
Okay, out of this 20 million, 15 million should be attributed to parent and 5 million should be attributed to NCI. Now, please understand. Now, in case if this does not exist, then your answer would have been 16. Got it? Now, 16 multiplied by 25%, you would have attributed 97 plus 4. Okay, and your answer would have been 101. Got it? Clear? Now you would have deducted loss, that is 20 into 25%. So minus 5.
Actually, I wanted to talk about this calculation only, showing it in brief.
I'm not getting your point. Showing it in brief where? Here, this way.
If we calculate the both answers, we are getting it like it's
Same impact. So you have to show it. This is incorrect, and you should show it the way we have already calculated. Anything that takes place, okay, during post period should be adjusted over here so that you are arriving at post acquisition loss. Firstly, we need to arrive at this loss and then this profit or loss, and then this will be further bifurcated into parent and NCI. Did I clear your point? We need to first arrive at, okay, we need to first arrive at exact after all the adjustments, Okay, any profit or any loss that has been earned by the subsidiary. Once we end up to that figure, then this will be attributed to parent and NCI. Okay.
Okay, ma'am.
Okay, good. So 291 will be added to retained earnings. We have already added 291. And NCI is, where is our non-controlling interest? Okay, I missed that non-controlling. Non-controlling interest is 96 and we have got this from working note number 6. Okay. 10% loan notes 120 itself. Okay. Now we can go ahead and start with our line by line consolidation. Okay. Property, plant and equipment equals to 640 plus 340. 640 plus 340 plus 38. Please add. Please add 640 plus 340 plus 38. 1018. Investments. Good. Investment will be again 0. Why? Because we de-recognize, eliminate. Investments 120. Okay. Investment 120. Why? Because they have issued loan notes of 120 and investments of 120. So net assets 120 and loan notes that have been okay. Next inventory is 76 and 22. Next inventory is 76 plus 22 minus unrealized profit of 2 million. Please calculate. 76 plus 22 minus 2. Very good. 96. Trade receivable. Good, very good. Trade receivable 84 and 44. 84 plus 44 minus 11. 117. Good. Cash in transit. Good, very good. Cash in transit is 4. So 4 plus 0 plus cash in transit of 4 million. That is 8. Grant receivable. Okay. Intellectual property. For intellectual property. So we have got our non-current asset total is this. Our current asset total is this. And our total equals to this plus 1391. Okay, next. Share capital. Share capital will only add of parent. Share capital of parent equals to 300. Share capital of parent equals to 300. So 300 plus equals to 300 plus 300 into 0.25, that is 75. 375. Anybody, any doubt in share capital? Good, very good. So total equity equals to 816. Then we have got NCI. Loan notes are 120. Loan notes are 120 plus 20. 120 plus 20. That is 140. Okay, we should have also added interest during the post acquisition period, that is 10%. So we can add 10% loan notes also. Okay, 90, 140. Then trade payable balances 130 and 57. 130 plus 57 minus intra-group balance of 7 million. So that is 180. Current tax payable 45 and 23. 45 plus 23, that is 68. Overdraft 25 and 0, that is 25 directly. 66 already taken care. One three nine one. Okay. Anybody, any doubt? Anybody, any doubt? Please raise hand. Give me a quick thumbs up. Is it clear? Good. Valentina, have you got a confidence? Like, can you solve more questions like this?
Yes, ma'am. Can you please take more sums if possible with loans when there is intra-group loans?
Okay. For
I'll try by
intra-group loans,
myself, and if I'll try by myself, ma'am, first, and if there's any doubt, I'll ask you.
perfect,
Because I
perfect.
think by passing journal entry, it will be more easy. Like if we
Agreed,
pass a journal
agreed.
and then
Superb. This is very correct approach. If you're stuck with any pointer, pass a journal entry. That's how it gives you clarity what impact will be taken to balance sheet and PL. Once you're clear with this, then it is very easy to prepare the FS with adjustment. Clear, correct approach. Okay. Also, now onwards, like maybe 1 week or 2 week later, we will start every week we'll be having 1 or 2 sessions for practicing questions, many questions, not only consolidation but other chapters questions also. We'll also take past year paper, full-fledged paper of 3 to 4 hours, and we'll sit together and try to solve it together. Okay, in upcoming sessions. Israr, okay, good. Okay. Yes. Yes, Valentina.
Ma'am, do we have a class on the coming Sunday? Because I had a few
Actually,
doubts.
sure. Actually, I'm traveling this week, so I'll keep it midweek or maybe next Sunday. I'll try to keep it midweek. Tomorrow I'll be from tomorrow I'll be traveling for 4 or 5 days. So next week I'll keep it. Okay.
Okay, ma'am.
Meanwhile, you can post your doubt. I'll
One
try to
last thing,
explain
ma'am.
in the WhatsApp group. Yes.
Okay, ma'am. Ma'am, what is the last date for registration?
It's 30th September. It can be done till 7th of October, but make a decision by 30th. As per my understanding, it should be submitted 15 to 20 days before. So to be on the safer side that you need to attempt on December, try to make sure that you uh, register by 15th of September itself, so that there are 15 to 20 day window is there. If there is any other rejection, adjustment, any other upload required, then there is enough time for you, because when you register on the last dates, sometimes your attempt gets delayed just because you have not got the confirmation for registration from ACCA side. So to be on safer side, I would suggest register by 15th of September, not delayed. Do not delay after that. Okay, otherwise, as per the guidelines, the last date is 7th of October.
And ma'am, last date for booking the exam?
It will be approximately 31st October, and sometimes a 3 day or 4 day grace period is given.
Ma'am, unable to hear you. Can you
It will
please
be
repeat?
end of October.
Okay, ma'am.
Okay. Anybody, any other doubt? Okay, good. Okay, practice well, pick up more questions, try to solve them, try to attend the remaining video lectures. Okay, if there is any doubt, meanwhile during when you are having your self practice and self understanding, okay, you can post your queries in the WhatsApp group. I'll try to resolve within a day. Also, upcoming sessions, it will be announced in the WhatsApp group itself along with the link. So make sure you attend them as much as possible. Okay, sure. Good one. Okay, I'm ending this session. Thank you so much. Thank you. Have a nice, I would say, good night, actually. Okay. Thank you. Thank you.